In 2023, the United States government spent about $6.1 trillion. It collected about $4.4 trillion in taxes. That leaves a gap of roughly $1.7 trillion. Now, where did that money come from? Not from savings. The government does not have a savings account. Not from printing. That is a different story and a messier one. It came from a mechanism so quiet, so deeply embedded in how modern economies work, that most people have never once stopped to ask how it actually functions. They just assume someone, somewhere, figured it out. And that assumption is exactly what makes it work. This is not a conspiracy. This is not a crash prediction. This is just the plumbing, the actual pipes behind the wall of every modern government on Earth. And once you understand it, you will never look at a government budget the same way again. Part 1. The Setup. Let's go back to something everyone understands. When you need money you do not have, you borrow it. You go to a bank. The bank checks whether you are good for it, and if you are, they lend you money on the agreement that you will pay it back, with interest, over time. Governments work on a similar principle, except the bank is not a bank. It is you. It is pension funds. It is insurance companies. It is other governments. It is financial institutions around the world. Here's how it works. When a government needs more money than it collects in taxes, it issues something called a bond. A government bond is essentially a promise, a very official, very formal IOU. It says, lend us money today, and we will pay you back in a set number of years, with regular interest payments in between. Those bonds are bought by investors, and that purchase of a bond is, in plain English, a loan to the government. That is the basic structure, but the basic structure is not the interesting part. The interesting part is what happens next. Part 2, where it gets strange. There's a third actor in this story, one that most people overlook: the central bank. In the United States, that's the Federal Reserve. In the UK, the Bank of England. In Europe, the European Central Bank. Every major economy has one. Central banks are not commercial banks. They do not take your deposits. They do not give you a mortgage. Their job, in theory, is to manage the money supply and keep the economy stable. And here's where the mechanism gets quiet. When a government issues bonds, it sells them on the open market. Investors buy them. Fine, straightforward. But the central bank can also buy those bonds. And when the central bank buys a government bond, it does not reach into a vault and hand over cash. It creates new money electronically from nothing and uses that new money to purchase the bond. Beat. Let that land. The government needed money. It issued a bond. The central bank bought that bond with money it created on the spot. The government now has the money it needs. This process has a name. It is called monetizing the debt, or, in the more recent and somewhat sanitized version, quantitative easing. Quantitative easing. It sounds like a spa treatment. It is not a spa treatment. What it means is that a central bank expanded its balance sheet by purchasing assets, primarily government bonds, using newly created money. Between 2008 and 2015, the U.S. Federal Reserve's balance sheet grew from under $1 trillion to over $4 trillion. Between 2020 and 2022, it nearly doubled again, reaching nearly $9 trillion. $9 trillion in assets purchased largely with money that did not exist before it was needed. Part 3. The uncomfortable math. Now let's talk about what this actually means, because there's a version of this story that sounds fine, and there's a version that sounds alarming, and the truth is somewhere in the gap between the two. The version that sounds fine goes like this. Governments need to borrow to function. That's normal. Most households carry debt. Most businesses carry debt. Debt, used carefully, is a tool for growth. Governments borrow to build infrastructure, fund services, respond to crises. If they can afford the interest payments, it's manageable. And for most of the 20th century, that version held. But here's the version that's harder to sit with. As of 2024, the U.S. national debt stands at over $34 trillion. The interest payment on that debt, just the interest, is now over $1 trillion per year. That means before the U.S. government spends a single dollar on defense, healthcare, education, roads, or anything else, it owes over $1 trillion just to service the cost of borrowing. To put that in perspective, $1 trillion is more than the entire GDP of countries like Saudi Arabia, Switzerland, or the Netherlands. It's the interest bill, not the debt itself, just the interest. Pause. Let the viewer process. And this is where the mechanism becomes interesting in a way that should make everyone slightly uncomfortable. Because when the interest bill gets large enough, governments borrow more to pay it, which increases the debt, which increases the interest bill, which requires more borrowing. Economists have a phrase for the point at which this dynamic becomes self-reinforcing. They call it a debt spiral. And most serious economists will tell you that no major economy has reached that point yet. Most serious economists will also tell you they wouldn't see it coming until it had already started. Part 4. The hidden mechanism inside the mechanism. Here's something nobody tells you in school. The reason this system works, the reason governments can borrow trillions without immediate collapse, is not purely because of economic logic. It's also because of trust, specifically the trust of the global financial system. When investors buy U.S. government bonds, they're making a bet that the U.S. will honor its debt, that the dollar will hold its value, that the U.S. economy will remain the anchor of global trade. And because most of the world's commodities, including oil, are priced in dollars, and because most global trade settles in dollars, there's a constant global demand for dollar assets, like U.S. government bonds. This is called the reserve currency privilege, and it's one of the most significant structural advantages any economy has ever held in history. It means the U.S. can borrow more cheaply than almost any other country on Earth, because the world needs what the U.S. is selling, a safe place to park money. But here's the catch. That privilege is not a law, it's not written into any treaty. It's a confidence game, a very large, very sophisticated confidence game that has run continuously since the end of World War II. And confidence games have a specific vulnerability. They run perfectly until the moment they don't. Part 5. Hype versus reality. Now, let's be careful here. There's a version of this story that gets told on the internet with dramatic music and countdown clocks. The dollar is collapsing, the debt is unsustainable, the entire system is about to implode. Buy gold, buy crypto, buy a bunker. That version has been wrong repeatedly for decades. Every year, someone predicts the end of the dollar. Every year, the dollar remains the world's dominant reserve currency. But there's also a version that gets told in official government communications and mainstream financial media. Everything is fine, the debt is manageable, growth will take care of it, stop worrying. That version has also been consistently optimistic in ways that have not always matched reality. The honest answer is somewhere in between. The mechanism works. It has worked for a long time. Modern economies do not function like household budgets. Governments can carry debt in ways individuals cannot. But the mechanism is not self-correcting. It does not have a built-in fail-safe. It depends on a set of conditions: confidence, demand for bonds, low enough interest rates, continued reserve currency status, that are real today but are not guaranteed forever. And slowly, quietly, some of those conditions are shifting. Part 5. The bigger picture.
China has been building an alternative payment infrastructure for years. The BRICS nations, Brazil, Russia, India, China, South Africa, and now several others, have openly discussed reducing dependence on the dollar in international trade. They haven't succeeded, not yet, but the conversation is happening at a level of seriousness that would have seemed fringe 20 years ago. Meanwhile, interest rates in the United States have risen significantly since 2022, which means the cost of servicing existing debt has risen, which means the annual interest bill keeps climbing. And the political appetite for the kind of sustained fiscal discipline that would meaningfully reduce deficits is at best limited on both sides of every major democracy's political aisle. Spending is popular,